Welcome everyone. This is the fourth episode of the course, fourth course video. This is one we're going to be covering the first use case of many that we're going to go over, but this one is derivatives on the blockchain. So firstly, what is a derivative? A derivative is a contract between two or more parties. The value of the derivative or contract is based on a singular agreed upon underlying asset, like a stock or bond or cryptocurrency, or a set of assets like an index fund. So the S&P 500 is an index fund. It is a fund that essentially you're investing in the top 500 companies in the stock market. And then also there's Bitwise 10. Bitwise is a cryptocurrency exchange where you can invest in an index fund they have, which Bitwise 10, it's in the name. Same with S&P 500. You're investing in the top performing cryptocurrencies as of now. Okay, and there are several types of derivatives on the blockchain. There are futures, swaps, and options. We'll get into each in a moment. Derivatives on the blockchain only revolve around crypto assets as of now. So any derivatives for traditional stocks and commodities aren't available as of yet on like a decentralized blockchain or exchange. So here are the different types of derivatives. Firstly, you have futures. Crypto futures is the most dominant crypto derivative as of now. In a futures contract, both the buyer and seller are obligated to buy or sell the underlying asset when the time comes in the future, and they do not have the option of backing out. Okay, so let's take a look firstly at an example on FTX, and then I'll show you something on Bitrue as well. So futures, essentially you are betting, essentially you're leveraging your money, right? With futures, you are taking a small amount of money and you're able to use that to leverage a larger amount. On FTX, these are your basic futures where you can either determine or either guess that the market is going to go up or down, and you position yourself accordingly. And you do not have the option of backing out with these. So this put right here, this is betting that the market is going to go down, and he used a small amount of money, $3,200, to leverage 2 Bitcoin. Okay, so he's using a small amount of money, $3,200, to leverage, to control 2 Bitcoin. Okay, and he has to sell at their determined date. But that's basically what it is leveraging your money for more. But then there's something else on Bitrue, which is called perpetual futures. This is something I personally use every now and then. But essentially it's the same thing. You are using a small amount of money to leverage a larger position. So with this, you can have up to 125 times your money. So if you had $100, you could leverage $12,500 with that. Okay, but keep in mind, the more you leverage, the riskier it is, and the faster you could get liquidated. Now, I don't want to make this like a crash course on what derivatives are and how to exactly to use them. I just want you to be aware that derivatives exist on the blockchain revolving around cryptocurrency, and you can do it on Bitrue. You can use it with all of these different cryptos: Bitcoin, XRP, ETH, ADA, just tons and tons and tons of cryptos. But just be careful when you're getting into it, if you get into it, because Bitcoin is a volatile asset, but it's more stable than most. Whereas if you were to take out a long position or short position in XRP, I mean, we've seen even just in the past week, it's been fluctuating 10 to 15% up and down, up and down. So if you're brand new to TA and any sort of trading like this, you got to be careful, because it can go against you in no time. And crypto especially is very volatile, and you can lose a lot if you're not educated and careful. So that's futures. Options is just like futures, but in options the transaction occurs in the future. This is the same with futures. Okay, so just like in futures, the options, my goodness, the transaction occurs in the future with a predetermined price. However, there's no obligation to go through with the contract if the buyer seller doesn't want to. So essentially they have the option to back out if they want. You are using a small amount of money to control a big portion of that asset. And that's it's the same with futures. I can show you just quickly options. I've never gotten into this myself, but just be aware that derivatives do exist on the blockchain, as I mentioned earlier. Then you have swaps. This is just simply exchanging crypto. This would simply be if you were to trade your Bitcoin for Ethereum, or if you were to trade USDC for Bitcoin. It is just a swap or exchange from one crypto to another. So pretty basic. Basically, if you go into an exchange, you can exchange one crypto for another. You could exchange USDT for XRP like this, or Bitcoin to USDT, all that. So it's pretty basic as far as derivatives go. Like, I'm only really involved in, obviously the swaps, but futures a little bit, perpetual futures. And actually, I didn't get into that, the perpetual futures. So with regular futures, you only, you're betting on a certain timeline. Whereas with perpetual, it's in the name. You can take out a long position and you can hold it for as long as you please, assuming, of course, you don't get liquidated. So you buy a short position at 41,400 and it continues to go up, 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 up. As long as it doesn't fall below whatever your liquidation mark is, which would probably be about 40,000. As long as it doesn't fall below that, you won't get liquidated, and you can keep that future open. So the difference between this and the difference between a perpetual future and a regular future would basically be that with a perpetual future, you have the option to sell out or liquidate whenever you choose to do so, assuming it doesn't fall below that mark. This might be kind of confusing to you if you've never done it, but again, it's not really important to know how to use derivatives in full. I'm not even an expert in that. I just want you to be aware of the various things that are available in DeFi. So here is a referral to that, to BitTrue, to sign up. I will leave that in the description link so you can click that. But anyway, let's get into risks, because there's risks with everything, risks especially with derivatives, futures, options. So these are for more advanced individuals that have skills such as TA, technical analysis, to be able to predict when and where the markets are going to move. Derivatives are a dangerous place for someone completely new to trading, especially trading in a volatile market such as crypto. First off, you have basic market risk, which everyone is susceptible to. Investors take positions in a market based off of their own assumptions of how the market will move. The possibility of the investor's assumption of where the market will move being incorrect is the market risk they take on. So basically, just an asset going up or down is it's an implied risk with anything. So firstly, with futures, you can use leverage in futures, which allows you to take a small amount of money and magnify it to take out a bigger position than you originally could with the small amount you had. With this leverage, you have the ability to make significantly more off of a trade, but with that, you also have the ability to take even more losses with small fluctuations in price. And that's what I mean by that leverage. You're taking out 125x, but at the same time, if the price is going up or down, or depending on the type of position you took out, whether it's a long or short, you're going to make a lot, but if it goes against you, you're going to lose a lot. Not financial advice. Okay, then in options. In options, there are various ways to trade, but the risks are similar to futures in terms of how, with certain types of options, your gains as well as your losses are amplified. With options, you have the ability to purchase X amount of a particular asset at a predetermined price and can only lose that sum of money, which is much safer in that aspect. And then swaps, finally. In swaps, you have the basic market risk, where the assets, such as Bitcoin, can either go up or down in value, and the amount of money you put into it reflects that movement. So it could be Bitcoin, Ethereum, XRP, whatever you choose to do. There is the implied market risk of, you get into it at 40,000. Let's say you purchase a Bitcoin at 40,000 and Bitcoin then goes down to 37,000. Your loss would then be 3,000. So that's just the basic implied risk that is associated with swaps. But that's really it. Like I said, not really super important to understand and have a strategy with derivatives. I just want you to be aware of the various things available in DeFi, the various financial tools you can use in DeFi that are available right now. So I didn't want to make this crash course on derivatives. I just want you to know what it is and just kind of create some distinction. So that's it for this. I will see you in the next video where we will be covering insurance. That's a good video, so see you there.